Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Akanda.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP Indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So the mission for today's analysis is to really dissect a highly speculative binary event turnaround play. And they're operating within the European medical cannabis market.
Right, which is a wild sector right now.
Exactly. And for everyone listening right now, the reason this demands your attention today is because the stock is currently halted.
Yeah?
Like, it is completely frozen.
Yeah, zero movement.
Right. Trading is suspended pending massive corporate news, which places us in this incredibly rare window of anticipation. A trading halt isn't just a pause button, it's a pressure cooker.
Oh, absolutely.
The chart is sitting at a complete standstill right before it potentially explodes upward or violently resets downward. We really need to figure out exactly what is happening behind the curtain before that halt lifts.
Yeah, and a regulatory trading halt tied to pending material news, it creates an absolute vacuum of liquidity.
Nobody can get in or out.
Exactly. Mechanically, the exchange stops all orders. Nobody can enter, nobody can exit. The market is essentially blindfolded, just waiting for the disclosure of a major corporate action.
And for this company, it's a massive shift, right?
It is. They are in the middle of executing a massive structural pivot, basically abandoning their old operational footprint to hyper-focus on Europe. The stakes for this company are existential.
Make or break.
Literally. If they emerge from this halt with a transformative deal, the valuation re-rates instantly. If the deal falls through, well, the floor could drop out entirely.
All right, let's move into wealth-building context.
Let's do it.
And I am going to challenge the core premise right here, because we are talking about a microcap turnaround play that is currently halted from trading.
Fair point.
Most people building long-term wealth, they're looking for compounding cash flow, reliable dividends, or at least solid blue chip growth.
Sure.
How does something that looks this much like a short-term gamble at a casino fit into a serious long-term wealth-building strategy?
Well, we really have to differentiate between the core of a portfolio and the aggressive allocation sleeve.
Okay, the speculative bucket.
Right. In wealth building, you rely on those stable compounders for the vast majority of your capital. But you also carve out a small, strictly defined percentage for asymmetric risk-reward setups.
Asymmetric meaning the upside is way bigger than the downside.
Exactly. The potential upside drastically outweighs the potential downside. With microcap like this, your downside is mathematically capped by your position size. You can only lose what you put in.
Right.
But the upside is potentially exponential if they capture what they are chasing. And what they're chasing is a geographic first-mover advantage in a rapidly liberalizing European market.
But I mean, Europe is definitely not North America when it comes to this sector. The regulatory landscape there is completely different, and it feels like it's shifting at a glacial pace.
Actually, the pace is accelerating dramatically, particularly in Germany, and this company is explicitly targeting a 10% share of the German medical cannabis market.
10% is huge.
It's massive. Germany recently moved to deschedule cannabis as a narcotic, which means doctors can now prescribe it much more easily, and the stigma for institutional distributors is just vanishing.
So it's opening the floodgates.
Basically, for a wealth builder, analyzing a stock like this isn't about day trading penny stocks. It is about identifying a massive structural macro tailwind, an entire continent changing its medical supply chain laws long before mainstream large-cap institutional capital fully catches on.
And prices that growth into the market.
Precisely.
Now let's look at the fundamentals.
Yeah, we have to.
And I'm going to be blunt. The fundamentals are brutal on the surface. If we were grounding this in reality, we have to look at the actual numbers.
They aren't pretty.
No, their annual revenue right now sits at a microscopic $836,000. Free cash flow is heavily negative.
Right.
And they have just taken an axe to their workforce, slashing it by 21.7%, down to just 14 employees.
Yep.
I look at those numbers, and it's like stripping a house completely down to the foundation.
Yeah.
You've got exposed wiring, no plumbing, no walls. It looks like a disaster zone.
I get that, but a disaster zone implies an accident. This is a deliberate demolition.
Deliberate. Yeah.
Management looked at their cash burn and realized their previous global strategy was completely unsustainable. They were trying to operate across multiple continents with limited capital.
Spreading themselves way too thin.
Exactly. So they made the decision to completely exit their African operations. They shut down a massive geographic footprint.
But cutting off an entire continent of operations means you are severing potential revenue streams. I mean, that's a drastic move.
It is.
How does a company with negative cash flow and only 14 employees actually plan to supply the largest economy in Europe?
By switching to an asset-light model, they don't need hundreds of employees because they aren't trying to do the physical heavy lifting of a massive agricultural operation anymore.
Oh, I see.
They are acting as a strategic licensing node. They preserved their cash to focus entirely on the high-margin European operations, specifically utilizing their exclusive licensing agreement with the Cookies brand.
Cookies, wait, the California brand.
Yes, Cookies is one of the most recognized high-THC cannabis brands globally. By securing the exclusive rights to cultivate and distribute that brand in Europe, they don't have to build consumer awareness from scratch. They have instant brand equity.
Okay, let's unpack that licensing mode. They are cultivating in Portugal to supply Germany. Why does that matter? Like, why can't a German distributor just buy from someone else if this company only has 14 people managing the operation?
It all comes down to regulatory compliance and switching costs. The European Union has incredibly strict good manufacturing practice, or GMP, standards for medical imports.
Oh, right, GMP is notoriously tough.
It is. So once a B2B distributor in Germany integrates a specific GMP-certified premium strain from Portugal into their supply chain, changing suppliers requires a massive regulatory headache.
It locks them in.
Exactly. It creates incredibly high switching costs. But to your earlier point about the stripped-down house, you still need capital to build the new structure.
Right.
This is where the recent financing comes in. In October 2025, they secured $8.7 million in post-IPO debt financing. This bridges the gap.
Wow. That number jumps off the page. I mean, they generated less than $1 million in revenue, yet they convinced lenders to hand over $8.7 million in debt.
Yep.
And that's on top of previous equity raises in May and October of 2024.
Yeah.
Lenders do not write checks that large to a microcap unless the mechanics of the payback are secured by something tangible.
Well, lenders look at the structural potential, not just the trailing revenue. That $8.7 million is a highly structured debt instrument.
Meaning they have strict covenants.
Right. The lenders are looking at that exclusive Cookies licensing agreement and the early supply contracts into Germany as collateralized potential. They see a clear path to European revenue scaling, and they're providing the bridge capital to get the product out of Portugal and into German pharmacies.
That brings us to the catalyst timeline.
Yes, the most important part.
Because a narrative about European expansion and licensing agreements is just a story until we have actual events that force the market to reevaluate the company.
Totally. The entire investment thesis hinges on the imminent catalysts. The single biggest immediate event is the lifting of the August 25th, 2025 trading halt.
Right, because right now it's frozen.
Exactly. And this halt wasn't random. It is directly tied to a pending share exchange with two entities called First Towers and Fiber.
Okay.
When a halt of this magnitude lifts, the market is forced to instantly digest the terms of that exchange and reprice the equity. The current valuation is essentially just a placeholder until those details drop.
Let's explain what a share exchange actually means in this context. It usually implies they're acquiring assets, swapping debt for equity, or absorbing another entity.
Correct.
And immediately following that, they have to prove the math works. The Q3 2025 earnings are going to be under a microscope.
Oh, absolutely.
The market will demand to see the initial impact of that $8.7 million debt injection. Like, are they just using it to keep the lights on, or are we going to see updates on their initial 1,000 kilogram shipment agreement to Germany actually converting into booked revenue?
Execution on that German shipment is really the only thing that validates the turnaround. And this is where the leadership catalyst becomes critical.
Terry Booth.
Yes. Terry Booth, the founder and former CEO of Aurora Cannabis, recently joined as chair of their advisory board.
That is a major addition. But why does a former CEO stepping into an advisory role actually move the needle for a 14-person company?
Because Terry Booth literally built one of the largest global cannabis supply chains from the ground up.
Fair point.
He knows the exact regulatory bottlenecks in international shipping, he knows the key institutional players in Germany, and he knows how to navigate capital markets. Having him on the board signals to institutional lenders that there is serious, proven adult supervision overseeing this restructuring.
He provides the blueprint.
He provides the logistical blueprint that a small team desperately needs.
We also have to zoom out and connect this specific microcap story to the broader macro environment. We're sitting in a market where U.S.-Iran peace hopes and massive enthusiasm around artificial intelligence have driven the S&P 500 to 8 straight weeks of gains.
It's been a crazy rally.
It has. And you might be wondering what AI has to do with a European cannabis cultivator. The connection is risk appetite. When the broader market is hitting record highs, capital feels wealthy. It creates a powerful risk-on environment.
Right, and that macro liquidity is the invisible engine for speculative stocks. In a bear market, capital retreats to safe haven.
Right, cash and bonds.
Exactly. But in a risk-on environment, institutional capital is willing to move further out on the risk curve to find outsized returns. That environment lubricates the capital markets, making it significantly easier for a highly speculative restructuring like this to actually find buyers and establish a new price floor once trading resumes.
Now let's pivot to the chart.
Yes, the technicals.
And the chart is mechanically very ugly. We need to dissect this history. We are looking at a 1-for-40 reverse stock split back in May 2024, followed by another reverse split announced in August 2025.
Ouch.
Let's explain the mechanics here. A reverse split is when a company consolidates its outstanding shares to artificially inflate the share price. You trade 40 shares priced at a few pennies for one share priced over $1.
Right.
Traditionally, this is the ultimate desperate bearish move. It's a mechanical trick to maintain compliance with exchange listing rules so they don't get delisted, and it almost always dilutes and destroys shareholder value.
The mechanical math of a reverse split is undoubtedly punishing to early shareholders. There's no getting around that. But you cannot view the August 2025 reverse split in a vacuum.
What do you mean?
You have to look at the psychological setup of the chart right now. That August announcement coincided directly with the trading halt.
Meaning the market hasn't actually had a chance to trade the post-split reality yet.
Precisely. The downward momentum that usually follows a reverse split is completely paused. In the world of microcaps, when you see a halt directly tied to structural overhauls like the share exchange we discussed, the chart enters a state of reset.
It's like a blank slate.
Yes. The historical price action becomes almost irrelevant because the corporate entity emerging from the halt will have a fundamentally different cap table, different assets, and potentially a different revenue profile than the one that entered it. Suspended momentum combined with material news often leads to violent upside gap-ups when the stock unfreezes, simply because the old technical resistance levels no longer apply to the new fundamental reality.
So what does market sentiment look like?
Well, on the surface, it's pretty quiet.
Yeah, if you just pull up the quantitative data, it is completely flatlined. Because the stock is halted, the algorithmic financial news feeds just lump it into generic sector updates.
Yeah.
There's no active narrative on Wall Street.
None at all.
If you go searching for analyst upgrades or price targets, you will find zero. Mainstream analysts simply do not cover halted microcaps with under $1 million in revenue.
Right. Mainstream sentiment is dead. But hidden institutional sentiment tells a very different story. You have to look at the paper trail of the specialized lenders.
Like who?
Think back to Viridia Canada, who led a debt round of over $500,000 in April 2023. Fast forward to today, and Specialized Capital is still injecting money. That recent $8.7 million round is the proof.
That's a huge vote of confidence.
Exactly. This demonstrates that insiders and institutional backers, the entities that actually have access to the unredacted books and the strategic roadmap, are highly confident. They are not cutting their losses. They are financing the bridge to Europe.
And institutional lenders have risk models that retail investors don't. They don't throw millions into a void without a clear exit strategy.
No, they don't.
And that brings us to the speculative rumor driving the sentiment underneath the surface. The whisper around this pending First Towers and Fiber share exchange is that it could actually be a reverse merger or an acquisition of a cash-generating asset.
Let's explain the mechanics of a reverse merger for a second. It is a maneuver where a private company acquires a controlling stake in a publicly traded shell company to bypass the lengthy, expensive IPO process.
It's a shortcut to the public markets.
Exactly. If First Towers and Fiber are injecting cash-generating assets into this public ticker in exchange for equity, it fundamentally re-rates the company's valuation overnight. They would instantly transition from a speculative licensing play burning cash to a capitalized entity with immediate European market share.
Now let's talk about the risks.
Good, because we have to.
And I am going to hammer on these because the bear case here is substantial. First and foremost is the dilution risk.
Massive risk.
When a company relies on post-IPO debt financing and multiple reverse splits, it usually triggers a severe dilution cycle. They consolidate the shares, the price naturally drifts downward, they issue more equity to service the debt, and then they have to consolidate again.
Right, the death spiral.
It is a mechanical death spiral for retail equity holders.
Yeah.
Furthermore, the execution risk is staggering. Yes, they have the cookies brand. Yes, they have an agreement to ship 1,000 kilograms to Germany.
What?
But as of the last report, they only have $836,000 in revenue. That is a colossal gap between the narrative they are selling and the cash they are actually collecting.
It is a gap. The execution risk is the exact reason this is halted and restructuring. But the mitigation for the bear case comes down to the current valuation floor. As we speak, the total market cap of this company is a microscopic $2.2 million.
Which is tiny.
It's nothing. At that level, your downside is mathematically bounded. A $2.2 million valuation means the market has already priced in the absolute worst-case scenarios. The risk of the German shipment failing, the risk of the debt becoming toxic, it is all reflected in that tiny market cap.
You're saying there's barely any further down it could go before hitting absolute zero.
Exactly. And regarding those reverse splits, while they hurt historical shareholders, they serve a vital function for the turnaround.
How so?
A company cannot attract institutional money or be included in major ETFs if it trades for pennies. Many funds have strict mandates prohibiting them from buying sub-dollar stocks.
Oh.
The reverse split is a necessary mechanical step to elevate the share price out of the penny stock basement, making it legally investable for the very institutional capital they need to execute their European expansion.
So with everything on the table, what's the final verdict?
Based on the underlying research and the dynamics of the trading halt, our final rating is a bullish score of 4 out of 10. We explicitly categorize this as a highly speculative, binary outcome investment.
So it's boom or bust.
Completely. The multi-year view here is that the target horizon is a speculative swing trade playing directly into the halt lift and the subsequent Q3 revenue ramp. If this company can execute its European pivot, successfully leverage the exclusive cookies brand for instant market share, and efficiently deploy its new $8.7 million war chest to fulfill that German supply contract, a $2.2 million market cap is drastically undervalued.
It's a huge if, though.
It is. It is a deep value binary event where the outcome will be extreme in either direction.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.